Well, good morning, everybody. We are going to talk about a few things today that are surrounding small business and how do we understand some of these challenges that come up as we've started our business and are growing it and are getting to a point where things start to matter from a financial position, from an investment position, from maybe your wife asking how much money you make and you haven't been taking a check home because you've been putting it back in business. So we figured we'd do some one-on-one questions about how does a small business really work, and how can we, as small business owners, start to understand some of those challenges? So I figured we'd start with some really basic questions from Ed and Ron and really ask them their points of view. They come from different spectrums on this, so they're going to probably have very knowledgeable points of view, but they could be completely opposite. And that's the real challenge of business, that there's a million ways to get to the end. So I'm going to start with Ed really quick and ask, what does a small business profit look like to the small business owner?
It's a great question, John. And the smaller the business, the more important this definition is. And to me, it comes down to your bank account. So you start the year with so much money in your bank account, and at the end of the year, you end up with so much money in your bank account, and hopefully there's a nice increase there, because that really represents your profits. It takes into consideration the revenue that you earned and collected, takes into consideration all the expenses that you paid, and it also takes into effect any type of investment you've made back into the companies. For instance, if you bought some type of piece of equipment, that would be an expenditure and it would take away from your bank account. So that to me is the essence of knowing whether you're making money or not.
And so just to maybe take it one step further, when you say what's in your bank account and maybe contrast that versus cash flow, maybe talk a little bit about the difference there.
Okay, well, cash flow is what ends up into your bank account. So there's measurements of cash flow, and usually the measurements start with revenue, and it takes away direct expenses to come up with a gross margin. And then it takes away your fixed expenses that you have in running the business. And then at the end, you have some type of investment back into capital and for running the business. And so at that point in time, you're calculating cash flow two different ways. One way, you're looking at the bank account, you're looking at the beginning balance and the ending balance. That's a certain amount of money. But when you do it the long form, by showing all the results for, say, a year, when you get to the bottom, they better balance. Otherwise, you made a mistake.
Right.
So I think a lot of times as operators, we focus on the side where we start with revenue and we look at the gross profit margins, because that's how you really figure out a way how to fine tune a business and optimize a business. You got to get into the details. Looking at the bank account ain't going to help you. You got to be able to analyze the business. So that's why you got to be able to break it down.
So I'll go back to the first question, Ron, and we'll just start there at the beginning. So you have the same sort of thought. What does a small business profit look like to the owner?
Well, I think that it's all the things that Ed said. Revenue minus all of your expenses, the purchases, the cost of goods sold, and then your expenses, et cetera. Of course, then you pay taxes. And if after everything is said and done, that's by definition, that's what profits is, which is really what Ed was saying. But I'm going to push back just a little bit on taking a look at an account and calling that any kind of profit at all in terms of what's in the bank. That's a measure of cash flow. I think I agree with Ed on that. And the reason is I've just had too many accounts over the 30 years I've been doing this, too many clients who have said, oh, I decided to take a nice end of year check because I had a lot of money in the account. Like, no. That's not how you determine that you should take money out of the account, because that's not, in fact, profit. And as Ed said, you have to look at the details. So I think that the bank account can be really, really scary for somebody to assume that if they have cash that they've made a profit, because mathematically, lots of times you can have cash in your account, but in fact, you did not make a profit. And so, if profits are going to be in the range of, we hope, 2 to 5%, and they're pretty extraordinary if they're 7 to 10% for most small businesses. Occasionally you see something going over that, and that would be as a percentage of sales. If you have really made money during the year, and everything else is equal, meaning your inventory did not change, that you did not buy equipment, that all you did is have the same normal regular expenses, then I think you could fairly say, yeah, I have 10% more money in my account, and maybe I can take a little bonus, etc. But it's much safer to consider that it's not you should be making decisions based on your income statement, not on your bank account. Now, secondarily, after 30 years of doing this, I also have a lot of I've had clients that commingle their bank accounts, and now they've got personal money in there running around with their bank money. We just started a company. We funded a company where he had his own personal account. No, you can't do that. You shouldn't be commingling those accounts. That causes all kinds of problems. So that little caveat, I would say, let's look at the financial statements, not the bank account, for whether or not you can take a big year-end bonus.
Well, that's a good segue. We're talking about maybe an individual owner that's starting out by himself into the next layer of ownership where you become a manager. And I think as you get more sophisticated in your management, you're going to have these tools like your P&L, like your balance sheet, like your income statements, and all that. And so that's really leads into the next question. How does a business owner drive profit when they're doing all the work? Where do they find this profit if they're doing the day-to-day stuff and not taking a step back and going, what happened? So maybe, Ed, you can look at that and expand on it.
Well, that's another good question, John. The bottom line is when you run a business and you're the key person in the business, you're the guy that is making sure that it works around the clock and you're meeting your objectives. You get so involved in running the business, making the deliveries. Johnny didn't show up today, so someone's got to be in the production line to take his place. What ends up happening is that you're disjointed in your approach of managing the business. You're not focusing on the right things, and you might be saving $20 an hour replacing somebody on the line, but in reality, your job is more of $100 an hour job or more, and you need to focus on your goals and objectives and your responsibilities of the business. Otherwise, everything's going to fall apart eventually. And then when you go on to sell a business, it's really much more valuable if you have a business that's running by itself and you are more like the chairman of the board, not involved in the daily activity of the business, but overseeing the overall process. So that's where you have your greatest multiples for the valuation of the business when you sell. So I think it's really important to try to remove yourself from the business and not try to save $20 an hour, but look at trying to add thousands of dollars an hour by doing things more productively and focusing primarily on your customers, making sure that you're meeting their expectations.
Yeah, I think that's a great kind of point of view, that we have to drive a business towards a multiple that you can step away from the business in a way that management can come in there. So maybe, Ron, you address it from a lot of your experience on the small business. It is just hard for the small business owner to get there. And so again, how does a business owner drive profit when they're doing all the work?
Well, it's possible to do that. And again, if you define profit very, very specifically, the word profit, it really goes back to our first question, and that is revenue minus expenses equals profit. Of course, you got to pay taxes on whatever profit. So that's profit right there. But I think you're asking a little bit broader question, and Ed did an excellent job explaining it. And I would only sort of add to what he already said by saying that, quote, profit, benefits, let's say, benefits accrue to owners in several ways. First, there's profit, and we've talked about that. Secondarily, there are expenses that you need in a business, maybe like a car or a truck, that can partially accrue to an owner. And so you say, well, gee, yeah, my business pays for my car. And so you got a nice big Mercedes and you're running around in it and, you think it's free, et cetera. Well, that's reducing your profit if you've overspent on that or you're spending more than the company can afford. Nonetheless, you do get the benefit of driving a nice car with the tax caveats that you have to reimburse the business. You should be reimbursing the business for non-business use. And then there are other kinds of things that fall in there that would include, if you're entertaining, you might be able to get a partially meal and you can buy tickets to the game and stuff. So there are some additional benefits there that accrue to a business. And there are a variety of other small benefits that can count towards profit. And then, as Ed mentioned, in the long run, as you're investing money in various things, the assets of the company very often don't depreciate to the same degree as it is reflected on the balance sheet. And therefore, if you bought a building with your business, you now have potential future, quote, profits. We would call that a capital gain officially, but you've got potential benefits to the owner because the business bought the building and paid all the expenses for the building. So there are several ways that you can benefit in a small business. Profit is one of them.
Well, that actually leads to, I think both of your answers lead towards a little change in my next question. I was really going to ask, should an owner take salary? But what maybe I'll ask a little different. What's a strategy for an owner to maybe take salary and profits in a balanced manner where, in our experiences, we've had owners that took too high of a salary and they're really starving the company. And we probably run into owners who take almost no salary, a really small salary, and take a big dividend or part of their profits. And so maybe go through some of the strategies there, Ed, about what's the best leverage for the company and the best for the owner, and what's the most maybe equitable for their dollar.
Well, another great question, I might add. You need to be able to figure out what type of worth you're bringing to the business, correct? But you also have to make sure you're keeping the business in business, because it's a lot of businesses go bankrupt because they can't meet their obligations. So someone has to really monitor that to make sure there's always enough money available to pay your vendors. Otherwise, you don't really have a business. So that's really important. And sometimes you run into differences on timing for cash flow. Sometimes cash flow can be high, sometimes it can be low. And if you're taking a salary out, when it's low, it makes it even worse. And I think when you're starting a business, you got to be flexible enough to be able to take money when it's available as compensation, but also keep in mind that you may end up having to put money back into the business to be able to keep it afloat when you're having challenges from a financial perspective. So there is no such thing really in my mind of a salary, because you own the business. Your goal is to keep the business going. And if you're taking a salary and don't have enough money to meet your obligations, you're going to go bankrupt. So I don't see how you can really take a salary until you get to the point where you're making a decent living, decent money with your business. Then you can take out a salary, and it's a modest salary. And I think one of the biggest risks out there for businesses where they take too much money out of the business, they starve the business, and the business doesn't have enough working capital to really bring in profit. And that's what you really got to be concerned about. And a lot of times when you're a sole owner, you kind of see it. You're focused on the business and you're dedicated to the business. You're going to keep it going. But if you have 5 partners and 3 of them feel differently, you got a real problem in managing the company.
Good point. So Ron, what are your thoughts on salary and benefits? And, you know, you kind of mentioned a lot with a small business owner, maybe kind of come off of Ed's thoughts.
Well, I've done, I think starting 6, 7 businesses. I've done all the different ways imaginable, I think. And, the one side of it is that if you're properly capitalized and if you're meeting your projections, you're hitting your sales target, you're keeping expenses in line, and you plan to make X amount of profit, and that includes a salary for yourself, write yourself a check every month because you're doing what you planned to do. And that's okay. However, don't overwrite the check. Don't take out too much, because where does growth come from? It comes from the profits. Okay, we just had a conversation about profits. Your profits have to fuel any growth that you have. And if you don't have profits to go in, you have to go borrow the money in order to be able to do that. And sometimes that makes sense and sometimes it doesn't make sense. So you don't want to overtake the salary. Now, on the other side of the coin, let's remember for just a second that if you are a subchapter S and or a proprietorship, you're really officially sort of taking a draw in a sense. Now you can write it as a salary and take it every month, but really it's a draw in the sense that you're going to get taxed for all the profits that the business makes personally. Therefore, you have to be sure that you're taking again the appropriate amount out so that you can handle that. But your everything that is made in that business in terms of profit is your responsibility to pay for the taxes personally anyway. Now you've got to have enough money to be able to pay those taxes, and so there's a little fudge there. But this draw that you take out of the business can't ever be so high that it, as Ed said, that it draws the business down and causes the cash not to be there. If you have a very small business and you're putting in a small amount of money and you haven't really capitalized it appropriately, the chances of you, quote, taking a nice salary to pay your personal lifestyle is pretty slim. And that means that you're going to have to figure out how to leave all of the money in there. Your sweat equity has to stay there in cash in order to fund the business because you were probably underfunded to start with. So, if you'll allow me a couple more minutes, I built a model a long time ago on this because I realized that this is a constant battle back and forth. And that is, you have to take a look at the needs of the business in terms of investment and cash flow, etc. And then you take a look, secondarily, you take a look at the profits and the cash flow, and you run it through a personal financial model. That personal financial model has to be met because you can't actually not take money from a business and then end up getting thrown out of your house, and the garage is what you're using for storage. So you see, this ties in really, really closely. And while you want to keep the accounting very much separated, separate business accounts, etc., so you can properly measure, you're still really tied in. And so you've got to have the right amount of money, not too much, but just the necessary amount of money, let's say, to be able to take care of your personal needs. And hopefully when you go into business, you've put yourself in a position where your personal needs are low. That's probably the advice there, not the salary side. Do it that way, because that way you can keep that money, you can pay your bills, keep the money in the business and grow the business. Now, if that doesn't work for an individual, you shouldn't go into business because you're probably going to fail. And that's going to be a lot more painful, and you could lose your house, etc. So the key here is, if you want to take a salary, you better be properly or overly capitalized if you really need that salary, but it's inextricably tied together.
Well, I think that's probably a great topic for another time about capitalization and salary. Maybe we can jump back to that. But to finish this one out, a couple more questions. One is really understanding these profits. Now, let's just say the company's making 10% profits. You know, what do I do with that, Ed? Do I pay myself? Do I put it back in the company? Are there rules of thumb on the investment of that back into the company, percentages, what are your thoughts on it?
Well, the first thing on your profitability is you got to pay your taxes. Ron talked about this. That's one thing you got to do. Otherwise, your future is not very long.
Yeah, right.
So you got to pay your taxes. So you got to take enough money out to do that. And then you should take out some money for the work that you put into the business. But you always got to take a look at what's left. And is that enough to cover next year? For instance, you may need a piece of equipment that's really, really important for growing revenue and cash flow. And it's going to cost $300,000. It'd be nice if you could pay for that equipment without taking out a loan, but you may have to take out a loan. But the bottom line is, it's probably the number one reasons why businesses go out of business is that they don't have enough working capital. And what's also strange about working capital is that if you grew your revenue, let's say you got lucky and you grew it 100%, and you drove your profits by 50%, there's a good chance that you are actually going to spend more of that 50% that you make, almost all of it, or even more than that, could be going into working capital, and you're not taking any real cash into your pocket.
Yeah.
So you have to guard against that too. So you got to make sure you're doing a good job collecting your receivables, keeping your inventories at the right levels for growth, but by the same token, not having too much of it on hand that you don't need. And that's really the tricky part of running a business. And a lot of people don't focus on the balance sheet. They only focus on the income statement, and they kind of miss that opportunity. So when we talk about what you really need, we need to look at the financial statements. There's 3 of them that are under GAAP. It's the income statement, the balance sheet, and the cash flow statement. And to run a business, really, you need all 3 of them to be looking at and understanding so that you can do a good job of running a business.
So your simple answer is that there is no rule of thumb for these numbers, and that you should probably, when you ask this question, you probably should be business mature enough to have those 3 GAAP statements working for you.
Exactly. Well said, John.
Okay. Ron, same sort of thing. What are your thoughts on it, if there's some rules of thumb and taking profits versus cash flow versus funding your business?
Yeah, and I think to kind of parrot you and Ed both, the simple answer really is very complex. That's a tough answer. The only time that you really take a bunch of money out of your business is when you close it, because assuming that you're growing every year, you're going to leave money in there. You have to. I'll give you an example. The first year I was in retail business, I'd had a medium year, made a little bit of profit. Well, no, I made a good profit. It was a small amount of business, but it was 10% profit. So the next year, my business went up 80%. Well, when you take last year's business and then you go up another 80% from that 10% doesn't calculate to be enough to grow that fast. You can't do it. It's a mathematical impossibility. In this particular business, this is an important part of the complexity, that you had to buy the inventory in order to drive the sales, in order to be able to have that kind of thing. And therefore, you need the money to buy the inventory, and the turnover of stock is only 2 times. Therefore, you're owning 50% of your inventory. Owning it, okay? How are you going to take just that little teeny 10% and fund 80% more? You see how that does not work. So as part of the answer to that question, it's really, well, what are you intending to do? If you have a 10% profit, assuming this is after you've taken the minimal salary that we just talked about, then you can say, okay, that 10% profit, depending on the volume, is going to be you're going to pay 2 to 50% of, in taxes. Let's assume you've got 8% left. So that 8%, you can allocate that towards new employees that you're going to have to pay for if you're going to grow, additional inventory, maybe you need a machine, maybe you need some remodel to your store, the various things that you need to do. It all comes down to forecasting. You do a forecast, a plan, because you need to know how to spend your money. So that's, that's sort of the one caveat. And the second part of that is that 10% doesn't show up at the end of the year. It's accumulated a little bit each month, hopefully. And therefore, chances of you having 10%, or in this case, we said 8% sitting there to make a decision on are almost impossible. You can't make a decision on that last 8% because it's not there. You've only got 2 or 3% that's sitting there and in the bank because you've been investing that money in this growth all the way along, and you're going to continue to invest it. There are mathematical formulas that you can calculate how fast you can grow so that you can determine if you can fund it yourself. And there is a limit to growth. And boy, do I know that, because for the next 4 or 5 years, I did nothing but pay vendors late. And you have to pay yourself a little bit. We talked about that, or maybe you don't, but you have to pay your employees, and you got to pay your taxes, and you got to pay your rent. You pay all of those things. Then the last guy who gets paid is the guy who you're buying from. And if you have credit, you're buying it on credit, and the expectation is you're going to pay it in whatever, 30 days, 60 days, or 10 days. And that money needs to be there on time. And I can tell you, you're in a world of hurt if you let that go on for very long, because you'll lose your credit. And now you're really in trouble because you don't have enough money at all, because you won't get any more merchandise until you now pay cash up front. So this is a good question in that it's really important. And I would say the mismanagement of the profit is probably one of the actual reasons, if we dig into it, as to why businesses go broke.
Yeah, I think
Not much of an
has,
answer, is it? That's not much of an answer.
it's a topic I think we could talk about forever. And I think at the end of the day, when we're in board meetings talking about the P&L and the balance sheet and where this money's moving back and forth, it doesn't mean much without the cash flow, and vice versa. I mean, the cash flow doesn't mean much without what's on the balance sheet. And I think inventories are, one type of business where people don't calculate the inventories correctly all the time. And it could be a big debate around the table with, even the gap compliance of what is the value of your finished goods in your warehouse, or what is the value of your retail goods in your retail market, and are they diminishing in returns every day, and do you sell it low, to get that cash back out? So maybe we need a whole nother conversation like that. But let's finish this with maybe the goal of this is we're talking about profits. In the end, what do you do with the business? Well, you sell it. That's really what happens. The life cycle of all businesses is sale. And as we all just went through in one situation, we were out shopping a business that we were involved in, and you think you're running a pretty good business at times, you think you're running hardest business in the world at other times. At the end of the day, you go and say, well, I want to sell, and they say, well, what's your EBITDA? And that's the only thing I heard. And yeah, I remember that in school. I have Ed here to help me remember what it really means. But that is the key question. To be a successful business, you got to sell your company based on some EBITDA. And so let's talk about that kind of quickly, and I'll let Ed define it. But why is it so important to get to this little number, this little thing at the bottom of your P&L statement to say, what's your EBITDA?
Well, it's funny, when you look at an income statement, you're normally not going to see a bottom line that says EBITDA.
Right.
You're going to see profits before taxes. So I guess the first step is to define what EBITDA is. And it basically is your earnings, but you look at your bottom of your income statement, you see that. And then you have to add back adjustments. Number one, interest. Interest is added back. It's earnings before interest, taxes, depreciation, and amortization. So normal businesses have to add back interest, because most businesses have an interest because they have a loan. And they also have to add back depreciation. And normally they start from a number before tax, so they don't have to add back taxes because they're looking at it before they pay their taxes. So it is really the accepted way of looking at buying a business. I've just recently gotten more and more of this. When I do valuations, I look at cash flow. cash flow to me is everything. But in selling a business, the first step everybody's going to ask you about is what is your EBITDA? And then once they know your EBITDA, they're going to assign some type of a multiple to it. And I think for most businesses, a multiple would be 2.5 to 3 times EBITDA. But if you're in a high growth area with a lot of potential, your EBITDA multiple could be double digit. Or if you're in a poor industry where you're just barely making it out, there's not much of a future, there might not be any multiple. So, yeah, you're right. You have to be educated to these things because you're so focused on running your business, making money. All of a sudden, you think you can sell overnight, which you can't. But the first question they ask you is something you don't know the answer to. So it makes you uncomfortable. And a lot of people just shut down at that point in time. They don't want to have to deal with it. Let's call in an expert. Maybe somebody can help us understand all this. But you should understand what EBITDA is because it's the metric that talks in the marketplace.
Well, that's a good thing. We'll have a whole conversation on, I think, EBITDA versus what you had mentioned, which is cash flow, and really understanding that the value of the business probably is more in the cash flow than it is in the EBITDA, but the EBITDA is the first question that comes across. And it gets even a little more sticky because a lot of times that's, NDAs are involved, non-competes, all these other lawyer documents that you don't want to even tell somebody your EBITDA. And so you end up with this funny dance, dating process to get to the EBITDA. And then they go, oh, I don't believe your EBITDA is that good,
Right.
So, Ron, 30 plus years and 400 or 500 clients you've talked to over the years. I mean, how many of our clients that we worked with had an EBITDA running and maybe frame that in, why it does matter towards the end. And maybe that's kind of a closing statement to the business that maybe in the year or two before you decide to sell, you start looking at EBITDA. I mean, maybe frame that.
Yeah, I think that the answer is 0 or close to 0. And the only time we would have a conversation about that is when I brought it up, or when I was having a meeting with the CPA who brought it up. And when a business is not looking to sell and they're not looking to compare themselves with anybody else, they don't really care about EBITDA. They just want to know how much money they can spend. But I think I think Ed answered it perfectly. I would just add to that I like it because it's the great equalizer. And the reason that the brokers and the people trying to buy businesses look at it is because they want to have an even kind of comparison to look at. So when you look at EBITDA from one business versus the other, it gets rid of the chaff, really, and you can actually compare apples with apples. A large business that has been around for a really long, long time could have should have big taxes. And a small business may not have big taxes. And so a large business that is making a 5% EBITDA compared to a small business of 5% EBITDA, you go, oh, it's 5%. But the large business might have been at 10% and paid half in taxes. You see, so that's why comparing profit alone isn't really the best comparison. And that's what I think is beautiful. Now, one final thing is, as you get a mature business, and you've been doing it for a while, and maybe it's only growing by inflation or inflation plus 1% or 2%, now you're beginning to look at other investments. And so we typically say, well, what's your return on your real estate investment, or your return on this or this? You've got all these opportunities. And when you begin to invest, you want to use something like EBITDA in order to compare whether it makes any sense. If you're going to put money in the stock market, how do you, Ed and I offline were having a conversation about the difference between bonds and stocks. Well, how do you compare what they should be? And the best way would be to take a look at the profits minus all of those other little charges, which mostly includes the taxes you pay. That gets complicated. How long did you hold the stock, et cetera, as to whether or not it's taxable or not taxable. The only way you can really compare those is its own little EBITDA. So that's why I think EBITDA is great. And that's why business people need to understand that EBITDA is that great comparison. The really smart business people that I know, many of them, a couple of them in the car business, when we have conversations about finance on, say, an endowment committee or something like that, everybody's throwing EBITDA around. And the reason they're throwing EBITDA around is that we want to compare in our minds how much money can we make, how much money can this trust make, how much money does the investment make. That's how you make those comparisons and make decisions about risk versus actual return. So
I think that's a great place to leave this, and I think we can have a lot more conversations about it. I think a couple of things we'll do moving forward are really have some very black and white how-tos on some of these topics, because the simple 101 questions of profit, when you go to school and you do it, you kind of go, oh, I made $12 profit, but they don't think about that reinvestment. They don't think about the future needs of their materials, whether raw materials, finished goods, whatever they're buying for their goods to sell again. That's a big thing. And so I think this is a great place to start, and we'll see you guys again.
sounds good. Thank you.